Welcome to another video of ours. My name is Robin, and as usual, I'm joined with Kirill. And today we'll discuss how Adobe might get murdered by Sora. Sora being a new venture of OpenAI, so AI-generated videos. And this video will discuss the fundamentals. Well, first the news, of course. So what is Sora and whatnot? The fundamentals. So how financially stable is Adobe? We cannot look into OpenAI as I don't think is publicly listed. So we'll focus on Adobe this time instead. Uh, and afterwards, we'll put a price on it using our own tool, and we'll show you how it works and how we do it and how we evaluate the company. So, Kirill, kick it off.
Yeah, let's get started. So recently there was some hot topic going on where OpenAI actually released that tool called Sora, where you can literally just plug in a prompt, a text prompt, and you're gonna get a video out of it. So you can even have a look. So it's, for example, says, yeah, golden retriever puppies playing in the snow, and it's actually making the video out of it. A little bit laggy and stuff, but maybe because of my internet, but look at that! It's just beautiful, and
Insane.
yeah, and the quality is also pretty good. I would say, you can see the fur particles and everything, and yeah, and it sounds like it's gonna be actually quite a hit on Adobe then, and these kind of editing, like video editing softwares, and yeah, Adobe is probably the biggest player on that market, and even based on that, you can see like on the day of publication, Adobe stock went down 7.5%, which is,
Crazy.
yeah, that hurts. That just sounds quite bad. So potentially it could also impact, let's say, the customers even further, because yeah, why would you need all that tooling from Adobe if you could just get it from OpenAI, from ChatGPT, and it's going to be just one subscription?
The thing also, though, is to consider the other way. So Adobe has also been introducing AI-powered, for example, Photoshop when DALI came out from OpenAI. So it's also to consider that they are already having some research and development in that area, and we can also check out what they might be doing with it. But in what sense will Sora defeat Adobe? Is it because just being able to not need an editor, basically? If it's going to be that good, you just put in whatever you want to show people.
Yeah, like that's the thing. Like, for example, for the past thumbnails for our videos, I was personally using DALI because I have a ChatGPT subscription with another friend of ours, and it works way better instead of you just spending your time, just editing a picture in Photoshop or in elsewhere, right? You just only put the prompt in. Maybe you're just gonna make some changes and fixes like marginally, but then you're good to go. So you save actually a lot of time, way more than it would be, doing the editing yourself. So
Yeah.
to me, as a user, that's way more valuable that you save your time, on these kind of things.
Yeah, exactly. No, I agree. All right. Shall we get the spreadsheet and look into the fundamentals? May check out what Adobe is all about.
Yeah. So as Robin said, we just plug it in our tool, which is called 930 spreadsheet, soon to be a web application. So soon. So yeah, let's have a look. So market cap of almost 250 billion, quite a lot. What also catches attention is pretty good gross margin of almost 90%, so it's like 87%. Looks good to me.
That's good.
And then the return on invested capital is also almost 30%, which is also good in comparison to the rest of the market, let's say. But then you also pay a bigger price, right? So the PE of 45, that's a little bit too much to my taste, I would say. Yeah.
Hmm. Yeah. All right. Let's go to the financials. So here we see that they have been growing their revenue, net income, free cash flow growth. Their long-term debt is covered by their free cash flow, basically meaning that if they would need to sell off their debt, they will be able to do so. And what's really good is that they have 1.7% share buybacks, which is what something you want to see. The pool is decreasing of shares, which means that value is generally going to go up instead of when the company dilutes you and creates more shares, it will decrease the value of a stock because there's more out there. So all in all, looks good. There's no dividend growth because they don't pay dividend, but yeah, that's something that you see a lot with big tech.
Yeah, fair enough. The only thing is, just to add up on the share buyback part, it's also worth to keep in mind that it's good that the company buys back its own shares when they're actually not expensive. So in case of Adobe, they usually had quite a high PE ratio, right? So it's also something which you can consider as not very wise way of spending investors' money. Because you just buy a very expensive asset, right, on your books, let's say, using your own money. So keep that in mind, but at least the good part about it is that at least the percentage is not that high over the past 5 years. So it's okay. It's not that big of a deal, but just for the future reference for you guys
Yeah,
as well. Yeah.
good.
So.
Uh,
Mhm.
yeah, if you look at the statistics part of things, so how it's organized, you immediately see some good things, right? So net earnings ratio above 20%, well above, which is really good to see. The averages out at 31%, which is really good. Normally, this will be interesting starting at 20%. So this is already a really good sign. The interest expense ratios, but this as most companies between 2 and 1, so nothing crazy there. Recent development is around 20%. You would likely to buy it a bit. You would consider a company having a good moat when the research and development is around 20%. And even though they are a big tech company, they have the R&D in line. So that also means that the business model works and they don't really need to upgrade it that much for individuals to buy it. They do market it heavily though, and this is something that is maybe a kind of a red flag. It doesn't really seem to sell that well if you need that much marketing and other instances to really push the product. And I think this might even get higher in 2024 with Sora and everything AI related. Then for the depreciation, it's below 10%, which is good. So yeah, that's from my side. Looks pretty decent, except for the selling and general expense ratio.
Yeah, and also maybe just to add on that is you can also say that free cash flow per share outstanding is also, let's say, decreasing from last year just because of the dilution, right? But also you can see that the free cash flow itself went down a little bit last year. So the thing is that okay, they do not really spend a lot of money on R&D. Now they have quite a tough competitor in the face of OpenAI, and you can clearly see that they would probably need to top up their game. And yeah, the way how you do it is you gotta spend more money on R&D probably. Introducing more of these AI tools. Having to spend more money on marketing probably as well. So yeah, that might also get create an impact on the free cash flow. So keep that in mind.
And then these things we already discussed, so we can see clearly the free cash flow growth over the years. The revenue growth at a steady 15% a year, which is quite decent. They've been growing the net earnings ratio on an average of 21% a year, which is crazy. But it also, you can see that in 2020, they had a growth of 78% and it went down from there. So we can be a bit more reasonable there. But it's nonetheless good numbers. And then here we see the shares outstanding change, decreasing over the years. But yeah,
Yeah, yeah, and it's actually good to see that there's a lot of green going on in here. So that's
exactly. Yeah.
quite a good
Yeah.
signal, let's say, right? And then you can see the same applying to return on capital employed, right? What we discussed in the beginning, it's in high 30s. Even last year was 40%. Gross profit margin 86. Operating profit margin 33%. That looks great. Cash conversion same, over 100%. So they are very effective in terms of making cash out of their operations, let's say. So that's good to hear. And interest coverage is also good, so they can pay out their debts pretty quickly, pretty easily, without any, let's say, hit on the financial results. So that's
Yeah.
that's good to see. But now the
Yeah.
question is, how would that result in terms of the price you should pay for the stock, right? That's
Exactly.
why we're here. That's why we're talking about Sora, I guess, right?
Indeed.
So,
So yeah, we start. Of course, we have a couple of things that you can tweak in our soon-to-be web app. So it's the growth points. How much do you think, for example, the company is going to grow? The high PE, the low PE, in order to get the average PE ratio used in the formulas. Then we tweak the required rate of return, discount rate, margin of safety, and also how long it would need to take for the discount, or at least for the cash flow to be discounted in your vision, in your mind. So let's start with how you would calculate the analyst growth points.
Yeah, so as usual, there are two ways how to do it, right? So either you can check the past performance. So, for example, check how it was been performing for the past years in terms of the revenue growth. We can just take it here from stock analysis. You can just easily copy paste it here. Soon, hopefully, it's not going to be needed because it's going to be all in a nice extended database we're creating right now. So I'm really happy about it. But
Yeah.
anyways, so for the past 10 years, the revenue growth was around 17%, which is very good, very healthy. It's always nice to see that. And in terms of the free cash flow, it's even better. It's 22%. So shall we put something 20%, something in the middle?
We can also check out what let's also see what the analysts think.
Yes. Yes, exactly. So for this purpose, we're just gonna go to Yahoo Finance, analysis, and when we scroll all the way down, as Robin usually does, and yeah, they say,
14%.
yeah, 13%. So, but what do you
Yeah.
think?
I think the averages is our most often rate.
Yeah,
So in this case, between the 20 and 13% growth
15,
per year.
something like
Yeah,
15.
and that's already pushing it, right? Because this is probably before that Sora was announced, as it is so fresh, right? So maybe we can also keep that in mind. So where do we see Sora going? How much is Adobe affected by the introduction of DALI, for example?
Yeah,
So yeah, I would definitely say not higher than 15% per
true.
year.
True. It's just also to be, to account for these risks. Yeah, it's just better
Yeah,
be safe than sorry, of course. Yeah, I agree.
yeah,
For the PE ratios, right? So we just also usually take what is the highest one and the lowest one for the past, let's say around 5 years or so. You can also do that on macro trends, for example. Just do the same. You can just check what was the lowest and the highest values, and it was as low as, let's say, 32, and the highs of 66, 67, I guess, right? Something like that.
yeah. And also crazy to see that the PE has been high for such a long time. It hasn't dropped below 30 in the past 5 years,
Yeah, but
which
I
is
guess the reason was is a competitive advantage part of things, right? Like,
yeah,
who do you know? Okay, for example, I remember for the competition for Premiere Pro, right? This is the video editing software that was Sony Vegas.
yeah,
That's the only thing I know, but I think nobody uses that anymore. And now it's a completely even different ball game. It's a completely different situation. You don't even need to edit your videos. You just can create a prompt, and the video is going to be created for you, and it's going to be way quicker. So
yeah. All right. So for the required rate of return, my mantra in this case, right?
be my
I should
guest, kind
say.
sir. Be my guest.
So basically, what you want is it to be above 10%. This is the reason is because if you would buy an ETF in the S&P 500, you would expect between 7 to 10% annual returns anyway. But because you're stock picking, you're taking on more risk, which also need to be paid out. And in this case, we settle mostly around 12%. The discount rate, we always keep it at 12%, but you can play with this as you go. And for the margin of safety, this is a measurement for you. Either you can be very conservative or so risk averse or not. It depends on a couple of criteria, for example, your age. So you can take on a bit more risk when you have a long horizon to recoup your losses. But when you're like 50 or 60 and you want to go retire anytime soon, then you would play a bit more conservatively. For me personally, it may be around 20 and 30%. With Adobe at this point, it is of course a bit iffy in what's going to happen in the future, but I'm a bit optimistic when it comes to Adobe, um, simply because you still need probably their software for at least the next maybe 3 years to edit it. So even if you have the prompts and you want to make a video out of it, you might still want to need Adobe to get everything nice and tidy into a clip. So yeah, with that being said, I think yeah. What do you think, at least, Kirill?
Yeah, it's definitely a tough cookie, but I would also keep probably the margin of safety 30%, because it's also something like you do not know how the customer would, or like consumer would rather interact with Sora, right? Either
Yeah,
it's actually going to replace let's say, the video editing as a process itself, then yeah, Adobe is gonna have some tough times, right? If it's gonna be like as a support activity, like for example, okay, I'm just gonna create the majority of my footage in there, but I'll be still doing the editing in Adobe with Adobe tools. Okay, that's is not, it doesn't sound so harmful, right? But then there's just a lot of questions in here, right? The same with DALI. Like for example, let's put it like that, because you work in the marketing area, right? You also probably
Mm.
gotta make some of these
Yeah.
nice footages and all of that stuff. How often do you use let's say editing tools?
It's not really on my department, to be
Okay.
honest.
Oh, okay,
Uh,
okay, okay.
yeah.
But like
So,
for
but I
example, your
know in the
colleagues,
company
yeah.
it is used a lot, of course. So we have a lot of clips, and it needs to be in one. So
Mm.
for most activities that are created, it needs to be edited for sure, constantly.
Yeah, so that's also the thing, right? So a lot of people already got used to certain tooling, right? So it also might take some time to kind of rewire towards something new. So there's pros and cons on both sides, but I would say, yeah, it's probably reasonable just to keep these kind of assumptions.
Yep. And I also
Um,
think 5 years is pretty decent considering all the changes that are now happening in the space.
yeah, yeah, yeah. And what we can see is actually it kind of makes sense because of the high PE ratio. The average valuations that we get
Yep.
is around $350, right? And given the margin of safety, it's about 250. It's expensive. Yeah, it's is it enjoying the monopoly? Probably does. Is it worth paying such a high premium? I don't know. But now there's even more questions with Sora and these kind of tools popping up. But even for example, if we put let's say the future growth of 22%, it's still not reaching the point of the current price. It's still a little bit
Yeah.
overpriced. So
And of course, yeah, the way that how we invest is we try to indicate deals with good companies and then buy them until they're overvalued.
yes,
For me, seeing already this huge overvaluation, like you said, even when you are more favorable on the growth estimates, yeah, it doesn't really it wouldn't signal a buy to me. But of course, this is not financial advice in any way, shape, or form. Please do your own due diligence, and then of course, if you have a better picture of the company, then you also know if these assumptions are right or whether they need to be tweaked or whether this price is actually something that you would be able to pay.
yeah.
But
Where
sometimes you also want to pay a premium if it's a really good company. But for me personally, I would not really invest in Adobe at this point.
yeah, it's more like what's important is about the process, right? It's not about, let's say, this specific company. It's about you having a proper, secure, step-by-step process how you would actually do your due diligence, and this is what we just did on the example of Adobe. Yeah. And if you
All
ask me
right.
questions, yeah, do you have a question, Robin? Tell me.
Yeah, where did we get the spreadsheet, Kirill?
Oh, I already got it covered for you, buddy. You can go to 930.com, quick and dirty, and you can just get access to it in one click. It costs only €1, just because we want to make a nice community, making it cheap and affordable. And also on top of that, if you're getting it at the moment, right now, you're also gonna get our web app, which is coming probably in the upcoming months. So I'm not gonna say anything more than that. Stay tuned. Have a good one, and see you guys in the next video.
Bye bye.